Zero-day to expiry options, so-called zero DTE options, have exploded in popularity in recent years. They now make up anywhere between 40 to 50% of all SPX option volumes on any given day. As volumes have grown in these products, so have concerns on the potential market impact of these options. Are zero DTEs contributing to higher market volatility? Could market makers hedging these options be what is driving S&P on an intraday basis? How do we evaluate and think about some of these concerns? Well, the important thing to keep in mind is that high volume does not necessarily mean high risk. What matters when it comes to determining market impact is not the gross volume, but rather the net positioning, i.e. the breakdown between buys versus sells, the balance between the two that determines the potential market impact. To think about it, simplistically, if 100,000 contracts trade on a particular line and 50,000 was customers buying and 50,000 was customers selling, then at the end of the day, there's actually net zero risk for market makers to hedge and therefore net zero market impact despite the high gross volume. Because the flow is perfectly balanced, there's actually net zero risk. So what does this flow in zero DTE option actually look like? Well, in reality, we find it fairly balanced between buys versus sells, such that the net positioning for market makers on average over the course of the day, we're talking about ranges from 100 to 600 million. How to put that into context? S&P futures trade about 400 billion a day. So we're talking about potential hedging flows that make up around 0.1% of the S&P daily liquidity. This is not a case of the tail wagging the dog. Now, you may be thinking, this is very different from other commentary that I've heard, some of the other numbers I've heard around, potential market impact. How do I make sense of all of this? Well, the one thing I would highlight is that at Cboe, we see the flow, right? As the exchange where all SPX options are traded, we can see behind every transaction, whether it's market maker or customer, whether it's buy or sell, opening or closing. Given that 98% of zero DTE options are traded electronically, meaning that third-party observers have very little visibility into this flow, the best they can do is make assumptions and estimates, whereas we actually see the totality of the flow and therefore have a better and more accurate sense of the positioning in these products. I think the key takeaway from all of this is that investors have found a diverse range of use cases for zero DTE options. This is not just one-way speculative flow betting on the direction of the market. Both institutional as well as retail investors use zero DTE options for a range of purposes, from hedging to yield harvesting to playing for intraday momentum or reversal. Because of the diversity of use cases as well as diversity of players in the space, this is why at the end of the day, the net positioning is so balanced and the market impact is so de minimis. Hi, I'm Mandy Xu. For more volatility insights, please subscribe to my mailing list at the link here.